In this video, I'm going to show you 9 ways on how to get rich in a bear market. And all that a bear market is when the market's actually coming downwards and not going upwards. Hey, my name is Sharran Srivatsaa, and I've had a chance to build and grow and sell multiple businesses. You're welcome to Google me if you like, but all I'm sharing this with you is that I'm just a random, handsome guy on YouTube giving you ideas on what you can possibly do, and you have to figure out if it's the right for you and your situation, all right? So let me actually walk you through 9 strategic ways on how you can actually take advantage of a shifting, negatively trending market. Some of these will apply to you, some of these won't, but I want to give you the exact process in all of these. The first one is what we often call portfolio rebalancing. So many of you in some way probably have some kind of stock allocation. And if you do, or if you don't, it doesn't matter. If you hate stocks, that's okay too. It's good to understand this theory overall. So how this works is, let's say you have a stock portfolio that is 60% stocks and 40% bonds. They call it the 60-40 allocation. Well, if the market comes down, this 60% drops in value a little bit. But what happens is that the mix of the portfolio changes. If that 60% drops in value, then this 40% is up in value, right? So it changes the mix of your portfolio. So now what happens is your portfolio is not 60-40 anymore. It's probably 50-50. And if the 50-50 allocation is not what you wanted for the future, so when you rebalance the portfolio, you would actually go out and either move some money from here to here or actually deploy some more cash and buy so that you get back to a 60-40. And if that's what you want for a longer term allocation. So just because if the market drops, it distorts that. And rebalancing is good because what you're going to do is you're going to buy lower to rebalance your portfolio, which then helps you on the rebound a lot. Most importantly, it helps you stick to your long-term plan, and it automatically does one thing. It moves money into discounted assets. That's why this is good. So if you don't do anything else, just think about a way to rebalance your portfolio. If you're part of like a 401k plan or something like that, there's probably an auto rebalancing feature somewhere in there. So take advantage of that. But one of the key aspects, if you're a passive investor or you're just letting the index funds and mutual funds do what you need to do, instead of it being at a time where you're like, oh my gosh, my stock portfolio dropped 10% in value, use that time to rebalance so that you can be well positioned for the future, and you'll start to see the gains in the future as well. So that is strategy number 1. Let me give you strategy number 2 is if you don't do anything else, by the way, please consider doing this. This is called tax loss harvesting, and not a lot of people explain how you do this. The most important part, I'm going to walk you through, this is probably worth the price of admission here. I'm going to walk you through a strategy where you can consider doing something. This is what I do for my family, and you can do this too, where you still get the loss and you can still get the exposure. So please let me explain. Why should you harvest losses? Tax losses in the U.S. tax code specifically, the U.S. tax code allows you to carry losses forward indefinitely, even if you don't use them. You can carry losses forward indefinitely until you die, which is insane. So if, for example, I have $100,000 worth of losses and I don't get to use it in this year, it's okay. I can bank them and I can still carry them forward until I die. So you can never have enough losses that are banked, especially when it doesn't change your exposure. So let's just say you have this exposure and you like this exposure to the market, and how can you actually harvest some losses? So the way this works overall is you can replace one stock with another stock, right? So for example, we call this a pair trade. So let's say you got Home Depot and you got Lowe's, right? And what you would do is they're both builder stocks. So let's say you have Home Depot. Home Depot has dropped in value. And let's say it's gone from $10 to $8. Well, you've got a $2 loss there. What you can do is you can sell Home Depot and then you can buy Lowe's. And you still get the same exposure to this building materials, but you get the $2 loss and you can bank the loss. So it doesn't change conceptually your overall exposure. You still get the loss. One of my favorite examples is a lot of people will have this ETF called SPY, which is the S&P 500. And the good part about the S&P 500 is that when you have it, and you can say, hey, let's say the S&P 500 started at $100 a share, and let's say it dropped to $80 a share. Well, you've got a $20 loss that you can capture. But how do you now buy a different SPY? Well, there are other ETFs and funds that you can buy the VO, which is the Vanguard. ETF for the same amount of money. So you still get to capture that loss and still get exposure to the market overall. So tax loss harvesting is a really smart strategy. If you you should do it in every market, but now is a very pronounced time to do it in this market because it gives you a very specific way to say, like, the market's down. Let's actually take advantage, take the losses, and still get exposure for what we want overall. If your advisor is not doing tax loss harvesting, I would highly recommend that they consider it, because once you do that, at least you have losses in this market and still keep your exposure overall. That is strategy number 2. Here's strategy number 3, and this is called the rebound positioning. Now, what is the most important part about the rebound positioning? The biggest gains come after the major drops. If you missed 10 days of trading, and were not set up for a rebound, you almost miss 50% of the value. I think something like, if you miss 30 days of trading, you almost missed 85% of the value. Imagine this: if you miss 30 days of the rebound, you lose 85% of the rebound value. So being invested and having the exposure is really good. So the question I would ask is, hey, how do you stay repositioned in all of this? So the primary way is to stay invested with automatic contributions. Whatever you were making contributions in this process, you want to continue making those contributions, because you're now still focused on the long term, because you're a long-term investor. You're not a speculator. I recommend against being a trader or a speculator, because in today's world, you have these fancy algorithms or bots that go out and can trade way faster than we do. You have big hedge funds that can do way more complex things than we can. You've got options traders that can run circles around us. So if you don't do anything else and you're invested in the market and you know it's coming, you just say, hey, how can I keep investing? Because you're dollar cost averaging into the market. If you're not familiar with the term dollar cost averaging, all it means is that you're constantly investing the same amount of money into the market, right? So every month you're putting $500 into the market. Every month you're putting $500 into the market. And just because the market is down, you don't wait for it to go down or time the market anyway. You still put the same $500 in the same cadence, because that way you get full exposure and you don't actually lose the rebound with it overall. History shows this. History shows that markets rebound quickly, and often begin to rebound quickly and quietly. You can't really time it. There's a way to actually kind of figure out when this is happening, and maybe I'll make a video on that. So let me know if that's interesting to you, and I can show you the technical way on when to actually start to see when the rebound is happening. But most importantly, this is not the time to stop contributions. This is not the time to back off, because if you miss the rebound, if you miss even 10 days or 30 days of the rebound, you lose a significant portion of the rebound. So stay invested. If you're a long-term investor, it will benefit you overall. Again, I am just a random handsome guy on YouTube, right? You want to make sure that this is the right strategy for you. If you need to use that cash flow for other reasons, we completely understand. But know that as you're a long-term investor, staying invested will allow you to take advantage of 2 very important things. Thing number 1 is this: don't miss the 10 days or don't miss the 30 days, because you're going to lose a significant portion of the upside on the rebound overall. All right, here's strategy number 4, which is, switch my pencil here. I call it the valuation advantage. Now, by the way, I'll give you all the slides. I'll link them all down below for your benefit here, because I put them together as notes for me to make sure I get the right information to you. The valuation advantage is this: you want, as the stock prices fall, they fall faster than the quality of the business. So here's what happens, right? Suddenly something happens in the market, like we currently had tariffs. Tariffs were put in place and the entire market took a hit. Well, from yesterday to today, a company can't lose 10%. Nothing really changed. They are doing the same exact thing. So it's not that the quality of their earnings changed. It's not that their clients changed. It's not that the customers changed. Disney is exactly the same as yesterday or today. Google is exactly the same as yesterday or today, but Google is trading 10% lower. So there's a valuation advantage. So you can get into understanding, you're like, why is the market down? And it took the value of the business down, and the business didn't change overnight. So technically speaking, unless the market was overvalued, that business probably has a valuation advantage for you to get into. So it is the same strong company, just you get lower entry points in this process, which means lower prices of getting in is you're going to get higher long-term returns. So if I can get in 10% lower in NVIDIA or Google right now, and you think that's fair value or under fair value, now you get a chance to actually benefit from that, which is amazing. And so But the most important thing is to do is to buy during the fear, not the hype, right? Buy during the fear, not the hype. It's very easy when you suddenly have a company like Google or Nvidia launch new things, and that's the hype. But in a market like this, when it's shrunk in value and the entire market's taking a clobbering, now you have a chance to say, hey, wait a minute, everyone is being fearful. Can I be a little greedy? Can I not buy into the hype? Can I buy it at a fair value? You've heard Warren Buffett talk about this idea a lot. You buy good businesses at a fair value. A lot of times we think that we have to get a good deal on all the businesses. You don't need a good deal on all the businesses. You just need to buy a good business at fair value, just not it overpriced all the time. So sometimes these bear markets allow you to get a good business at a fair value. All right, or maybe even a discounted value. But here's the most important part. Here's what I call strategy number 5, which is this emotional training. Well, what's emotional training? Emotional investing leads to poor returns. As soon as you see, the tech sector go up and AI come about, you're like, man, I want to invest in all these technology companies. Or you see the market gets clobbered, you're like, I want to pull out right away. That's very normal. And all the gains that happen for everyone else in the market happens because of all of us, because of the emotional trades that we make, and then we get really, really, really get tough. So the first one is you want to drive everything by discipline. And what I mean by discipline is 2 things, all right? 2 things. Thing number 1, if you can invest in groups. So I have a mastermind group for my investing through YPO. And I always, before I make any major decisions, I talk to the group first. And while you're in a group conversation, the group will calm you down. And it's been super helpful for me overall, because it's not that I'm sitting there in my head, in my fear, making a decision. And the second thing that I want to tell you about is this idea of finding the best value price. And I'll give you an example of a best value price. So you may say, hey, I like Goldman Sachs at $26 a share. I'm just making up numbers, right? And so you write down. So I have a list of companies that I like and I want to own, and I know the best value price I've associated with it. So I'm like, hey, I will own Google at $37. I will own Nvidia at $118. Normally when it splits, etc., I refactor for that. It's more based on evaluation. But I always want to own that stock at that number. And to me, that best value price is interesting, because as soon as something hits that best value price, I don't think anymore. I've got discipline. I'm not emotional right now. So when I have the group theory, when I can talk to somebody and I know that I'm always happy owning something at the price that I preset even before this ever happened, that's really good. So the suggestion I would make to you is, as you go through this process, whether you invest in any companies or not, whether you buy the discounted companies or not, I would ask yourself, you know what? If I were offered a Rolls Royce for $500 brand new, would I buy it? Well, the chances are yes. If I were offered an Apple Watch for $10, would I buy it? Why? Because your best value price. It's no different than a company. If you say I've got Goldman Sachs or American Express or Home Depot or McDonald's or Lowe's or Nvidia or Netflix or Google, and if you know the price that you're willing to own them at, that's a good thing. Also, this also applies to real estate. So I know we have a lot of real estate folks that want to invest in real estate. It's no different than saying, hey, that building over there, I would own that building for $1 million, even though it's trading at $3 million. If that building was ever on sale for $1 million, I'm going to buy that building. But once you have that in mind, when that building hits $1 million, you know that you've given yourself discipline-based permission to buy the building, and you don't need anyone else's thinking around it. So the 2 things are, think about investing in groups so you can have a discussion around something. And second, all the things that you have in your life, which you want to own, which you want to buy, always know at what price you're going to buy it at, because when the markets fall, you get a chance to buy it at that price. The other is you want to automate to reduce fear and greed. I talked to you about this. So if you are currently in the habit of doing the to call it $500 a month, then you just automate the $500 a month. You just do it every single time and nothing changes. So it automatically hits your account. It automatically goes to investing. Most brokerage platforms can do that. So it's a good thing for you to do. Now, I'm using a stock example for you to do that. This could also be a maybe you want to automate your investing so that you can save enough up for a down payment for your first home, or you want to automate your investing so you can buy your first investment property, or you want to automate your investing so that you can have a passive income operating system, like my money coaches Russ Morgan and Joy Murray would say, that you can put into your infinite banking policy. Whatever it is, if you know you're going to do it, you got to automate it, because you don't want to have to make an emotional decision around, oh man, I don't know what's going to happen right now, right? So it's you want to have some version of that, because I think it's really, really helpful if you can have the automation component associated with it. It's the same exact thing. This talks about setting rules before emotions hit, and that's, I like to call it, the best value price, right? So hopefully that's helpful. You don't want to think about how you feel in the morning and invest based like that, because no matter what decision you make, I will tell you right now, no matter what decision you make, you never feel good. Because if the market drops and you decided to sell and get out of the position, you're like, man, I lost some money, and now you're thinking about that. And then it goes down some more. You're like, oh man, I wish I should probably buy some right now. Should I not? It will always mess with you. So it's a lot easier pre-writing the rules for a situation like this than any other time. Let me give you like a 10-second story. When I was younger, I had this fear that I would lose everything. And I was talking to my coach one day, and I once lost everything. I didn't have a lot to lose, but I lost everything once. And I told my coach that I fear that I'm going to lose everything. And she said, why? And I said, this happened before. And she said, what did you do? I said, I figured it out, but it was really difficult. She goes, okay, well, what we're going to do right now, Sharran, is we're going to make a plan for what happens if you lose everything. So she said, assume you lost everything yesterday. What do you do today? So I wrote a one-page plan on, if I lost everything yesterday, what would I do today? And instantly, I calmed down. Now, I anything can happen, but whatever happens, I know that I've written that plan, and I know what I'm going to do, and I'm always kind of thinking about making sure that plan is in a good spot. So the investing in a bear market is no different. You get a chance to say, hey, if the market goes down, what are you going to do? Right? And if you pre-write that plan, you can then, when it does happen, you can just execute on the plan, as opposed to reading the headlines or working through the emotional gyrations associated with all of this. Cool. Here is strategy number 6, and I call this the global perspective. And what I mean by this is we are so attuned to looking at stuff at home that we forget that the world is flat. So if you're in North America, US, or Canada, you realize that we have robust stock markets, but so do the rest of the world. And in a time like this where you have tariffs, etc., the US stocks may be overvalued compared to its peers. You have no idea. There are emerging markets that can be really enticing for investment. And also what it does is it spreads the risk out a little bit. So I'll give you an example. If, for example, and we now live in a world where you don't really have to even go to that market to trade it. I remember the time when I first started investing. If I wanted to buy say stocks in the UK, we had to go to the UK or the UK stock exchange. You had to have like a specific brokerage account and then have to buy it there. Right now, you can trade any stock anywhere, anytime. And there's also ETFs, which are exchange traded funds, which are funds that track certain countries. Right? So just like we have the S&P 500, which is the 500 biggest companies in the US, or the Dow Jones, which is the big industrial companies in the US that drive the market. What if you said, hey, India's population is going to increase by 30% in the next 10 years. If India's population increases by 30% in the next 10 years, you would wager that they're going to need more healthcare, they're going to need more technology, they're going to need more infrastructure, and there's going to be more investment in that country, meaning there's also going to be more consumption in that country. So do you bet on India over the next 10 years, if not anything else, for the country to grow? And if you think that's the right bet, then you may want to I think it's called INID. It's maybe the thing of India. I can't remember. Or the NFTY. These are the tickers for India. I'm pretty sure it's this. I'm not quite sure if it's that. But you can buy the entire Indian economy. And so if I bought the Indian economy today, and I knew that in 5 years that's gonna happen, so I buy the economy today, and now I own a piece of the India's growth. So you can actually get exposure so easily doing this. This is called a thematic investment. You don't have to go buy one stock in India and hope it does well. You just get access to the thematic growth of the country overall. Right now, based on the global perspective, if you say, hey, in this trade war, I think India is going to win, I think Vietnam's going to win, I think Australia is going to win, I think the US is going to lose, whatever you come up with, you have a chance to bet on a theme over the next many years. And that we are all long-term investors. We don't pull money out right now. We're not day traders, right? I'm also a random handsome guy on YouTube, and so I'm just giving you ideas on thematically how to think about this. But you get a chance to actually have a global perspective and invest in a country overall, which helps you think about, hey, how can I do something good for the future, right? Pretty cool. Here is strategy number 7. And strategy number 7, a lot of times people don't realize, in a time like this when the markets are kind of in a bearish way, a cash strategy is important. I want to give you a thinking process around what my money coaches Russ Morgan and Joey Murray call lazy cash. Lazy cash is when you have cash sitting around, generally speaking, and it's not working for you. I always have this phrase that I tell my friends, I tell my family. It's like I wake up in the morning and I go to work. My money wakes up in the morning and my money goes to work, right? If you don't think about it that way, if you have, pick a number, 20% of your net worth, say your net worth is $100,000 and you have 20% of your net worth called $20,000 sitting in your bank account to make yourself feel better about yourself, that means that money is not waking up in the morning and going to work. It's sitting there lazy. That's just like you laying in bed. It's laying in bed as well. So there's this idea of lazy cash. But in a bear market, lazy cash is not a bad idea, because the entire job of cash in a bear market is to be opportunistic. And what does opportunistic mean? Opportunistic means that you're getting a fair price or a deal on something that you normally would not get. And I'll give you a simple example. What is crazy to me is this. Let's say Macy's is having a sale, or let's say Benetton is having a sale, or let's say Louis Vuitton is having a sale, let's say BMW is having a sale, or let's say they're even 7-Eleven is giving out free slushies that day and 50% off, or Dunkin' Donuts is having a buy one get one donut free day. When we see sales in the retail world, we all rush to that sale. But when we see sale in the stock market, when we see sale in the bond market, when we see sale in the real estate market, why don't we rush to it? Because we're fearful, right? Because we have not built a best value price beforehand, because we've not built a plan beforehand on what exactly happens at that time. Just because the sale happens at Banana Republic, we get to go to that. But why aren't you excited about the same sale that is happening on Netflix stock? That actually probably will pay you way more Banana Republic for your life. And that's why this is opportunistic. So there's no reason to rush. You just got to wait to understand deals. Your goal is to be opportunistic. And they call this having dry powder. Having dry powder that you can toss around in a time like this is really, really important. So in a normal environment, having cash sitting around is lazy cash. But in a bear market, when the market's going downwards, having cash sitting around is okay, as long as you're opportunistic, as long as you're saying, how do I buy something, how do I get a deal on something right now? How do I get a Banana Republic in the stock market or the bond market or the real estate market or the crypto market, right? That's how to think about it. All right, here's strategy number 7. I got to really hammer this home. And this strategy is that you are your number one asset. Now, I had to share this because actually this was my number 1. I didn't want to put number 1 because you'll be like, I can't believe Sharran's going to sell me coaching or something. I have nothing to sell you. I don't even have a PDF to sell you. Even the link that you're going to get down below, you don't even need to give me your email address. I'm going to put the slides down. It's just a Google Drive link. Just grab it as long as it's helpful to you. But there's nothing more important that is going to give you the best possible results in your life than this one thing, which is investing in yourself and in your skills and in your capabilities. At the end of the day, we are only valuable to the marketplace because of our skills, our knowledge, and our capabilities. If we can't deploy skills, knowledge, and capabilities in the marketplace, we are SOL. So if there is a time right now, I would ask yourself the question, what skill do I wish I had in today's economy? What skill do I wish I had? And I bet you can say, well, in 3 years, in 5 years, what skill is going to be useful? And I'll give you a simple thought process of what I did. So you want to use some quiet time to build, not just scroll. You want to use some quiet time to build, not just scroll. And what I mean by that is, I will tell you how, when this whole AI revolution came out, I will tell you exactly what I did. I am a computer science and math major. I have written code. My first exact gig was I built and grew a software company before we sold it. So I understand what an engineer is. I have an engineering background, so I get it. However, there's a lot going on in AI these days. And I was like, how do I keep up? How do I learn? How do I do this? So last year, I decided to do something. I decided that every night before I went to bed, I would watch one video on AI, just one. So over the course of last year, I've watched over 350 plus videos. And I realized something. My knowledge of AI went from zero to hero. Like I know everything about every platform. I've actually played with it. I know I'm not enamored or I'm not surprised by the new advances. I know the terminology. I know what can actually work. I'm good at prompting. All because I spent the 360 plus days watching one video a day learning about AI. I realized that that was a skill of the future and I needed to build that. And if I didn't build it, I can't teach it to you. I can't use it in my companies. I can't teach it to my team or my employees. So I wanted to make sure I shared that with you. That may be one idea. You may say, hey, I want to go learn I want to go learn how to be a phlebotomist. I want to go learn how to be a soccer coach. I want to go learn how to be a life therapist. I want to go learn whatever, right? And if you want to learn the skill that can make you better, that could be really good. Maybe you've chosen to say, hey, I want to learn a skill to make my finances better. I want to get an MBA in personal finance. All of that is good. The key here is you are your number one asset. No one can take away your skill and your capability from you. Whatever happens, however happens, you can show up in the marketplace, deliver value, and you are hired, and you can get paid, and you can put food on the table, and you can take care of your family with your skill and your capability. The question I would ask is, what is that thing? What is that thing you want? And what is the thing you can say if it starts out? You may be like, hey, what can I learn in 90 days? And you can get, by the way, you're watching this on YouTube. You can learn everything on YouTube. Worst case scenario, you get a course for like $50 or something like that, and you can learn whatever you want right now. And what can you learn for none of this was available before. What is one thing that you can do to invest in yourself? Because in a bear market, when things are a little slower, instead of doom scrolling, could you do something to invest in yourself that can help you learn so that you can develop your final being the asset that is you? All right. Super important. If I could only say one thing right now, this is what this would be. But I know many of you are here for the tactics. I have one more big idea for you, and that idea is this. And I call this asset-backed lending. Let me actually explain what this is. This is the idea of becoming your own bank. I know BYOB stands for other things that people talk about, but becoming your own bank. And what I mean is that during times like this, in recessionary or bear market-like environments, something very interesting happens. So let me explain what happened. The average business starts to like average business in your community or that your friends know or operate, they lose access to capital. And if the rates are changing fast, the banks don't know how to lend. The banks are like pulling back and saying, hey, I'm not willing to lend to this lend anytime right now until we get more certainty. Banks do really well when they have certainty. They don't do well when they don't have certainty. So a lot of your friends who run businesses are going to go and look for private capital, especially lending. They're going to say, hey, they need money to go buy inventory. They need money to go for cash flow. They need money for payroll. They need money to go maybe buy another competitor that is not doing well right now. They need money to do that. But where do they get the money? They don't have access to the traditional financing. And that's where you come in. I've done this multiple times. And in times like this, it gets very interesting because you can ask for significantly better terms. So let's say I'm making up some numbers. Let's say I wanted to invest $100,000 into a company, right? In a normal market, I would invest this $100,000 and I would get maybe it would be a loan and it would be unsecured. Meaning there's no collateral to be backed by it. But in today's market, I could say, hey, I will give you $100,000, but I want real estate as the collateral, or I want the inventory as the collateral. Now I can say, now I'm safeguarding my investment because they can't get those terms anywhere else. I'm safeguarding my investment because now I get a lien on this property. If something happens, I get to actually activate that lien and protect my investment overall. This asset-backed lending, this is the asset, which is the real estate or the inventory, in the asset-backed lending, which is really, really powerful, right? I've also done a deal where I've done, I have made an investment and then got equity in the company. So if they don't pay, I actually get equity in the company. I've also gotten a stream of royalty payments saying, hey, I'm going to make this investment in 3 years, no matter what. I also get a stream of royalty payments going forward. There's so many ways you can structure it because the company now needs the cash. I'm not saying to be predatory anyway, of course not. But you're giving them a chance of saying, hey, I'll give you this, but you're getting better terms. And business is all about getting terms that you want. It's really, really good. All right, so this is a chance for you to become your own bank. I want to give you a pro tip on this one. When you're getting started out doing something like this, private lending is very hard. Private markets are really hard. And you got to get good attorneys, good CPAs, good advisors in the process. But I like doing this in groups. I like investing in groups when I'm doing private deals. It allows me to invest in with other people that are already doing something like this. It allows me to invest with other people that have maybe complementary skill sets that I don't have, and allows me to understand that wow, that's how they think about the world and how we can do this better together. So when you're doing something that is fairly new to you, I suggest doing it with a group or doing it with a mentor or doing it with a coach. I like doing it in groups because that way I can take 3 or 4 of my really good friends together. We can all put in $25,000 each and make this investment. Each person brings a different kind of background and ask questions to the table. Now, if a deal happens, then you all get to talk about this deal. You got to celebrate together when the deal wins. You all get to like work together. It helps your relationship get better. So I'm a big fan of investing in groups. That's why I get a lot of deal flow, because people show me more and more deals because I've shown them more and more deals. A lot of times people ask me, Sharran, how do you get all these deals? I'm like, because I showed all these people all these deals for the last 10, 15 years. Now they're going to show the same to me as well. So I wanted to give you a sense of how all of this works, but most importantly, give you a path give you 9 ideas on how you can invest in a bear market. Now, please remember this. I am just a random handsome guy on YouTube. And hopefully this process is helpful to you. What I will do is I will take this entire PDF. It should be down in the link below. No email address needed. Just grab it if you think that it can be helpful to you. And remember this. You want to make sure that whether the markets are going up or markets are going down, you have some kind of plan. Before you start reacting emotionally, just write a little plan. The plan could be, when I say write a plan, it could be 3 to 5 bullet points on what you're going to do and how you're going to feel. And when you do that, you have a really good sense of what to do next. So hopefully one of these strategies are interesting to you. If you think this is helpful, send this to your advisor or someone that's helping you with all of this. Share this with a friend, because making money in any market is possible right now if you know the plan. Until next time.